Mary Kay Wright with the Right Choice Adapt Properties, and we're here with Angie Wozniak from Midwest Lending for another round of Mortgage Monday. So thanks for joining us.
Thanks for having me.
Angie, for our consumers and buyers out there, can you explain the difference between an adjustable rate mortgage and a fixed rate mortgage?
Absolutely. So they're kind of exactly how they sound. A fixed rate is fixed for that entire life of the mortgage. So a 30-year fixed means for 30 years, your interest rate will not change. It will remain the same. Same goes for a 20-year fixed, 15, any combination.
Okay.
Fixed is fixed. Adjustable rate is still amortized generally over 30 years,
Right.
but it is only fixed for a certain amount of time.
Okay.
So we have 3, 5, 7, 10, even a 15-year arm, where in that case, that rate is fixed for that amount of time.
Okay.
And then after, it is subject to change with the market. That is something to check with your loan servicer. What is their policy? Will that change yearly? Will that change monthly? Generally, it's yearly,
Okay.
but that's something to be mindful of in this market with rates being as low as they are. As a finance person, I am risk averse, so I would say take the fix, leave it, don't worry about it, because an ARM, you never want to be, on that time crunch. Hey, it's year 4 and rates are a lot higher than they were.
Right.
There's been, maybe I can't qualify for the same mortgage that I did, so you never want to be stuck in that position. So if you are contemplating an ARM, I would definitely have that conversation with your mortgage professional and kind of do a dive of where am I thinking I'm going to be by the time. Yep, absolutely.
Weigh out the pros and cons.
Absolutely.
Gotcha.
Definitely. All right.
Great info.
Thanks.
Thanks, Angie. We're happy to have you. And we'll be back next week for another Mortgage Monday. Thanks, guys.
Bye, guys.
Bye.